60% stocks at age 60, or 100%. Hello, Diamond NestEgg members, super savers, and bond course fans. I hope you're healthy and well. So one of the questions we get often in our community is how much in bonds versus stocks should you hold in your portfolio? And as so often, the answer is, it depends. So with that in mind, here are the three topics that we'll be covering today. 1. What is the rule of 100? 2. How has this rule evolved in recent years? And 3. What are the three key considerations when deciding the bond versus stock allocation that may best suit you? Let's dive in now, folks. What is the rule of 100? When I first started in finance in the 1990s, now I'm dating myself, but it sometimes feels just like yesterday. But when I first started in finance, the general rule of thumb for allocating stocks versus bonds in a portfolio was the rule of 100, whereby we take 100, subtract out our age, and what's left over, that's the percentage of our portfolio that should be allocated to stocks, and the rest of our portfolio would then be allocated to bonds. Because as I often remind people, it's not just about getting to retirement, it's about getting through retirement. So it's prudent to have some portion of our portfolio in stocks even as we age. Some portion of our portfolio allocated towards capital growth versus capital preservation. Getting back to the rule of 100, this means that if we're 60 years old, we would take 100, subtract out our age of 60, leaving us with 40, meaning 40% of our portfolio should be allocated to stocks, and the remaining 60% would be allocated to bonds. And for those of you who want to learn more about bond basics and how to build a bond portfolio, our President's Day sale is on right now. Learn everything you ever wanted about fixed income. Use coupon code INCOME2026 to take $100 off of our popular bond course bundle before midnight Eastern Time on Sunday, March 1st. Our bond course bundle includes both our foundational level bond beginners course as well as our intermediate level bond masters course. And for 2026, we've upgraded our courses to lifetime access. I've included the links below this video for your convenience if you want more details. And if you already understand some of the basics of bond investing, come on over and join our VIP investment club, where our members have daily conversations with me, Marcus, and one another on the best rates and what they're investing in right now. Hot topics the past few weeks have covered everything from the tax advantages of treasuries and munis through a good mixture of different types of bonds to mortgage REITs and onto more advanced topics such as preferred stocks, international investing, as well as gold and precious metals. Basically, whatever our VIP members have as top of mind topics for the day and or week. And this $100 coupon code, INCOME2026, can be used for our bond courses as well as to join our VIP investment club. Quarterly if you want to test it out, semi-annually if you want to stay flexible, or annually if you're like most of our VIP members and want the best value. For now, though, let's continue with the topics for today's bond versus stock allocation video. How has this rule evolved in recent years? Over time, as people started to live longer, this rule of 100 became the rule of 110. So instead of 100 here, we use the number 110, which means that if we're 60 years old, 50% of our portfolio should be allocated to stocks. 110 minus the age of 60, and the remaining 50% would be allocated to bonds. And over even more time, as people started to live even longer, the rule of 110 has evolved to where it stands now in the second half of the 2020s, the rule of 120. So with 120 here, this means that if we're 60 years old, 60% of our portfolio would be allocated to stocks. 120 minus the age of 60, and the remaining 40% would be allocated to bonds. Meaning that based on the rule of 120 that many financial advisors are currently favoring, a 60-year-old would have a portfolio allocation of 60% in stocks and 40% in bonds. Compare that to a portfolio allocation of 40% stocks and 60% bonds based on the rule of 100 in the 1990s decade. The stock versus bond percentage allocations within a portfolio have basically been reversed due to people living longer and enjoying more years in retirement. Here's the stock versus bond portfolio allocation percentages by age using the rule of 120. This column shows an investor's age. This column shows the percentage that should be allocated to stocks, and this column shows the percentage that should be allocated to bonds. Now, keep in mind that the rule of 120 is just a general rule of thumb. So, for example, if you're a 50-year-old who's less conservative or who has other assets like an investment property, a company pension, or an annuity, then you may want to consider allocating a higher percentage than here to stocks and a lower percentage than here to bonds because you have other sources of predictable income that you can depend on. And if you're a more conservative 50-year-old, for example, someone who loses sleep at night every time the stock market goes down, then you may want to allocate a higher percentage than here to bonds and a lower percentage than here to stocks because stocks, generally speaking, tend to be more volatile and unpredictable than bonds for buy and hold to maturity investors. As I always say, everyone's financial journey is different, and as personal circumstances and preferences and or markets change over time, people will often adjust their portfolio alongside. In fact, let's take me personally as a real-life example. When the COVID pandemic hit in 2020, I was in my 40s. Let's say I was 45, because that's what's on this table here. Meaning that according to the rule of 120, I should have had about 75% of my portfolio allocated to stocks and 25% to bonds. In reality, I had 100% of my portfolio allocated to stocks and 0% to bonds. Now, I spent a fair bit of my early banking career in high-yield debt. But for my own personal portfolio, I always felt based on my age, risk-return profile, and the overall low interest rate environment pre-pandemic that with stocks, I'd get more bang for my buck, so to say. Well, this changed when the Fed started hiking rates in early 2022, and inflation shot to nearly 10% in mid-2022. That was actually when we started shifting more of our portfolio into fixed income. And now, at the time of this taping, we're around this 25% bond allocation number based on the rule of 120. And I can still sleep well at night with this allocation because I have no plans to retire for at least another 15 to 20 plus years. But again, that's me. The point is, don't view this rule of 120, these percentages, as set in stone. Rather, think of them as a starting point for understanding the mix of stocks versus bonds you should have in your portfolio at your life stage. And once you have this starting point, this reference point, so to say, you can then adjust it to your own individual circumstances, goals, and expectations. Again, if you're enjoying this video so far, use coupon code INCOME2026 to take $100 off of a popular bond course bundle and VIP Investment Club membership before midnight Eastern Time on Sunday, March 1st. Our bond courses are the first step in learning all about fundamental treasury, agency, corporate, and municipal bond concepts and how to build a bond portfolio. And our VIP Investment Club allows you to advance beyond that and dive deeper. Remember, our Diamond NestEgg VIP Investment Club is the ideal place for you if you want to 1. Have an extra pair of eyes for critical investing questions. 2. Get ready for the retirement decisions that lie ahead for yourself or a loved one. 3. Understand how a product works, its benefits, and its risks. 4. Be the first to know about safe and or higher yielding investments. 5. Spot and clearly understand new market trends and issues. 6. Exchange perspectives with a like-minded community. And or 7. Continue your lifelong learning about investing and retirement. If you fall into one, some, or all of these categories, visit our website after this video at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button or this Bond Course Bundle button to learn more. I've also linked everything below this video for you. Let's move on now to the next topic for today. What are the 3 key considerations when deciding the bond versus stock allocation that may best suit you? Now, let's look at 3 considerations that you should keep in mind when you start thinking about your personal asset allocation strategy. First, the rule of 120, or rule of 110, or 100 for that matter. It's not the only allocation strategy that you could use. Now, I personally like it because it gives you a simple enough mechanism for managing your portfolio, while at the same time being flexible enough to grow with you as you progress on your financial journey. But I think you should be aware of the alternatives out there so you can choose what's right for you. For example, you've probably heard of the famous 60-40 strategy that says you should always keep 60% of your assets in stocks and 40% in bonds to get to a balanced portfolio. Or the self-explanatory 100% stock rule, which is sometimes also called the nothing to lose rule for investors with a long time horizon and high risk appetite. And there are many more asset allocation rules out there that stay the same forever, what the market calls fixed strategies. Some of these are associated with well-known names such as investor legend Warren Buffett, Yale endowment manager David Swensen, or Harry Brown, the inventor of the permanent portfolio. Now, these fixed strategies may be simple to understand and are being widely applied in real life as well. But in my mind, as I said before, they have the big downside that they don't necessarily grow with you, nor do they always set you up for a smooth transition into retirement. On the other hand, there are also so-called factor-based or dynamic allocation strategies out there that get more complicated by including additional factors, such as risk tolerance-based allocation strategies or risk parity approaches. And some active managers don't want to have their hands tied by a predefined allocation strategy at all, but will try to improve their results by shifting the portfolio with a short-term horizon in a so-called tactical asset allocation approach that always keeps looking out for the next market opportunity. These approaches may have their merits as well, but I personally think that some may be just too complicated to implement for self-directed investors. Plus, just like for the fixed allocation strategies, not many of these approaches are really designed to prepare you for retirement and ensure a smooth transition, which is one of the key assumptions we have. So, to say it once more, I personally remain a fan of the rule of 120, and it's a good balance between staying simple and growing with your life stages. That said, there is one limitation we should mention. The rule of 120 is really focused on the 2 core asset classes of bonds and equity. So your emergency fund, for example, or any other cash assets would be an additional amount of money at your disposal, but would not necessarily count as either equity or fixed income for asset allocation purposes. Similarly, the rule of 120 also does not provide an explicit allocation for alternative assets, or alternatives for short, which would be pretty much any investment that you could not classify that would not behave as either a stock or a bond. This could be a direct investment in oil and gas, an investment property, gold and precious metals, or something else altogether. Now, that does not mean that you should ignore alternatives altogether. The way we personally treat these would generally be to put them in a separate side portfolio for alternatives and keep them outside the rule of 120. But you would adjust your risk tolerance based on the alternative assets you own. So, for example, if you're a 60-year-old investor who would get to an allocation of 60% stock versus 40% bonds under our standard model, but you own a property that is rented out, in such a case, and because a rental property would provide you with some extra income and probably make you more risk tolerant, you might increase your stock allocation to 80% and keep only 20% in bonds instead of sticking to the 60-40 allocation. The second point is about rebalancing. The rule of 120, like any asset allocation strategy, does require you to keep an eye on your portfolio and to react to both changed personal circumstances and developments in the market. And the best way to do this is to rebalance your portfolio in regular intervals, most commonly every year. At these rebalancing checkpoints, you would compare the actual assets in your portfolio to the target numbers according to your strategy, and you would then make the necessary sales and purchases to get the portfolio back on target. In the case of a rule of 120, the regular rebalancing will achieve two targets. First, it will adjust your portfolio to the new target allocations as you move into the next age bracket. And second, at the same time, you will also react to how the market has been performing since the last rebalancing. So let's take an example and say you look at your portfolio, and after an extremely strong year in equity markets, it shows 75% stocks versus 25% bonds, while your target allocation calls for 60% stocks versus 40% bonds for this stage of your life. This means that you would now sell as many equities and buy as many bonds as you need to get to your target allocation of 60% versus 40%. Now, a strict rebalancing can sometimes feel a bit forced or unnatural to some investors. Apart from adjusting to your new age-based allocation, why, for example, would you always sell your best performing assets? For instance, after a good year in the stock market, your stock positions will be up, and now you have to sell exactly those well-performing stocks to buy underperforming bonds? Conversely, after a bad year in the stock market, when your equity position has shrunk in value way below the target allocation, precisely at this point, you would now sell the stable and well-performing bonds to buy equities that haven't been doing so well. But that's exactly one of the purposes of regular rebalancing. It forces you to sell high to buy low, to modify the famous saying a bit. In other words, in our example, you sell your equities and take the profit when they might be at a cyclical high, and you put the money into bonds that should remain more stable and conserve the value when the stock market starts falling again. Or in the opposite scenario, you sell some bonds and buy equities while they're cheap. And if you stay disciplined, this may, over time, allow you to get a bit of an extra return on your portfolio. Now, to the third point. Do note that with this rule of 120, even though I have run this table out to age 85, for those of us who are planning to follow legendary investor Warren Buffett, who only announced his retirement as CEO of Berkshire Hathaway at the age of 94, do note that the rule of 120 is most applicable during the accumulation phase of our life, when we're focused on capital growth. During the decumulation phase, when we retire, some of us may need to tweak to fine-tune our allocation based on the size of our nest egg, our budget, market performance, and other prevailing factors at that time, which we dive deeper into in our intermediate level Bond Masters course. Learn everything you need to kickstart your financial journey in fixed income with us. Use coupon code INCOME2026 to get $100 off our popular bond course bundle, as well as our VIP investment club, and be a part of the daily conversations that our VIP members are having about money, investing, and retirement. Visit our website at www.diamondnestegg.com and select the option that interests you most to learn more, or see the links below this video. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed this video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.